Hello and welcome. Today, we're taking a really in-depth look at one of the most fascinating corporate transitions happening in the market right now. In this explainer, we're breaking down Pfizer's August 2026 financial status and really trying to bridge that massive gap between their historic peak during the COVID era and what's coming next with their future clinical pipeline. So, let's jump right in. Just a quick heads up before we get into the numbers. Please remember that everything presented in this explainer is strictly for educational and informational purposes. This isn't financial advice, it's not an investment recommendation, and it's certainly not an offer to buy or sell securities. Always make sure to consult a qualified financial professional before you make any investment decisions. Okay, with that out of the way, let's get started. Here's our agenda for today. We'll kick things off with the Q2 2026 earnings breakdown, look at the big headwinds from COVID and the patent cliff, explore their future pipeline growth catalysts, discuss some legal risks with Depo-Provera, and wrap up with the current valuation and market verdict. All right, Section 1, Q2 2026 earnings breakdown. Let's peel the onion on Pfizer's financials and see what happened when they opened their books. So right off the bat, there's this massive and honestly pretty fascinating disconnect between Pfizer's reported and adjusted numbers. Wall Street was actually cheering an adjusted earnings beat of 77 cents per share, which beat estimates by over 13%. But if you look at the reported gap, it actually showed a 4-cent loss. You might be wondering, why such a huge gap? Well, the company had to take a massive $4.3 billion non-cash impairment hit. This was mostly tied to the failure of their lung cancer drug sigvotatug-vedotin in a key trial. It's a really harsh reminder of the clinical risks baked into the pharma industry. But those adjusted numbers do show us the actual underlying operational story. And honestly, that operational story is actually looking quite solid. If you strip away that one-time $4.3 billion hit and you exclude the declining COVID products, Pfizer's underlying business actually grew 5% operationally year over year. And a huge chunk of that strength comes down to one staggering figure: $3.2 billion. That's the quarterly revenue generated entirely from newly launched and acquired products. We're talking about an 18% operational growth right there. So it's clear they're doing a great job integrating new assets into the fold. Because of that operational strength, management confidently raised their full-year revenue guidance to a midpoint of $61.5 billion. The big takeaway here is just the remarkable consistency we're seeing from CEO Albert Bourla and his team. I mean, they've now beaten consensus revenue estimates in 9 of the last 10 quarters. And a major standout performer was their bladder cancer drug Padcev, which grew over 20% and now actually covers the entire bladder cancer treatment continuum. Moving right along to Section 2, headwinds, COVID, and the patent cliff. This is the massive chasm Pfizer has to cross. Because as strong as their execution has been, Pfizer is stuck in this historic financial tug-of-war. The first massive headwind pulling them backward is just staggering. At their peak back in 2022, Comirnaty and Paxlovid brought in an incredible $56.7 billion. But fast forward to 2025, and that plummeted to $6.7 billion. And for this year, 2026, it's estimated to drop even further to just $4 billion. Just think about that for a second. Over $50 billion in top-line revenue has literally evaporated in just 4 years. And as if that wasn't enough, here is the second major headwind: the looming 2026 to 2030 patent cliff. Over the next few years, Pfizer loses exclusivity on a staggering list of blockbuster drugs. We're talking about heavy hitters like the blood thinner Eliquis, the cancer drug Ibrance, Xeljanz for autoimmune diseases, and Xtandi for prostate cancer. To put that into perspective, this loss of exclusivity is expected to wipe out $1.1 billion in sales this year alone. It's a huge hurdle. So, let's jump to Section 3. Growth catalysts and the future pipeline, building the bridge to future revenues. To cross this crazy chasm of declining legacy revenues, Pfizer is aggressively building a bridge. They're leaning heavily into 3 distinct pillars of future growth. First is the obesity market, which Goldman Sachs actually projects will hit nearly $114 billion by 2030. Second is a groundbreaking Lyme disease vaccine. And third is a rapid, incredibly aggressive expansion of their oncology portfolio. Let's look at their play in obesity first. Through their acquisition of Metsera, Pfizer got their hands on Berobenatide. Now, while current market meters like Wegovy and Zepbound require weekly injections, Pfizer's drug starts weekly but then transitions to a monthly maintenance dose. That is a massive convenience advantage for patients. And the data? Phase 2b trials showed a 15.9% non-placebo-adjusted weight loss at week 60, with absolutely no plateau in sight. They're targeting first approval in 2028 and are launching over 20 obesity studies this year alone. Next up, the Lyme disease vaccine. Want to guess how many approved human vaccines there are right now for Lyme disease? Zero. Exactly zero. And it affects over 100,000 people annually in Europe alone. While Pfizer and its partner Valneva recently achieved European Medicines Agency validation for their candidate, which is based on phase 3 trials showing over 70% efficacy. If approved, Pfizer would basically have a monopoly in a market with a highly unmet medical need. And the third pillar, oncology. The momentum here is totally palpable. They are eagerly anticipating the MEVPRO-1 phase 3 trial readout for prostate cancer coming up in Q4 of this year. Early data showed it essentially doubled progression-free survival, which is huge. Furthermore, their legacy Seagen portfolio delivered a massive 21% U.S. growth. Add to that a recent FDA approval for Ibrance and frontline breast cancer maintenance, plus a priority review for Padcev, and you can really see how oncology is becoming the bedrock of their future revenue bridge. All right, shifting gears to Section 4, legal risk, weighing the Depo-Provera litigation overhang. We need to impartially look at a significant legal development that's been making some headlines recently. So Pfizer has been facing federal lawsuits alleging that its contraceptive, Depo-Provera, caused intracranial meningiomas, which is a type of brain tumor. There are more than 6,200 pending cases right now. Just recently, Pfizer reached a settlement program targeting about 5,000 of those claims. Now, while the official financial terms remain confidential, third-party estimates value the aggregate settlement at over $1.2 billion. That breaks down to roughly $250,000 per participating claimant. Now, it's absolutely crucial to note here that Pfizer has not admitted any fault or liability in connection with the settlement. They are strictly resolving the claims without admitting any wrongdoing. However, this is still a potentially material legal development. And why this matters to us is that investors are going to be very closely watching Pfizer's future filings to see exactly how these charges will influence their litigation reserves and really their overall risk profile going forward. Which brings us to Section 5, Valuation and Market Verdict. How exactly is the market pricing this whole transition? How are investors weighing these incredible pipeline catalysts against the patent cliff and the legal risks? Well, mid-August 2026 metrics show some real momentum. The stock is trading near its 52-week high, right around $28.24, capturing a 14.1% 30-day return. But the real standout figures here are the yield and the valuation. Pfizer currently boasts a highly attractive 6.09% dividend yield, paying out 43 cents a share quarterly, and a historically cheap forward PE ratio of just 9.26. By historical pharmaceutical standards, the market is pricing Pfizer at a pretty significant discount right now. And the smart money is definitely seeing value at this price point. Institutional investors hold roughly 68% of outstanding shares. This is led by heavyweights like BlackRock at nearly 9% and Vanguard at roughly 6.5%. And while analyst consensus is a bit mixed between buy and hold, their price targets range anywhere from $25 on the low end to $35 on the high end. That suggests a lot of confidence in that dividend floor while everyone waits for the pipeline to mature. That brings us to our conclusion, the tug-of-war verdict. Let's summarize this really complex situation and balance the scales for Pfizer in 2026. When you zoom out, the tug-of-war is just incredibly clear. The bull case pulls on a fat 6% plus dividend floor, a super cheap valuation under 10 times forward earnings, and a remarkably exciting pipeline packed with obesity, vaccine, and oncology catalysts. Pulling in stark contrast, the bear case relies on the sheer math of those declining COVID revenues, the impending 2026 to 2030 patent cliff expirations, somewhat flat near-term earnings guidance, and of course, the legal overhang of the Depo-Provera settlement. Which leaves us with the ultimate question, really the single metric that will define Pfizer over the next 5 years. Can Pfizer commercialize its new obesity treatments and oncology pipeline fast enough to outpace the devastating revenue losses of the looming patent cliff? The bridge is definitely under construction, but the cliff is rapidly approaching. Thank you so much for joining me for this explainer. If you want to understand where the pharma industry is heading, you definitely need to keep your eyes closely on Pfizer. Until next time, keep learning.